You've done the research, the technical setup is flawless. You click buy, but almost immediately the price starts to slip, a slow, agonizing dip into the red. Your heart races, the sweat starts, and before the trade even hits your planned stop loss, you panic and exit. You exit to stop the pain, only to watch the screen in horror 10 minutes later. The chart reverses, shoots straight past your original entry, and easily hits your profit target. This recurring cycle of self-sabotage is a direct product of psychological hardwiring overriding a sound technical strategy. Millions of retail traders use the same moving averages and RSI levels, yet only 10% of them consistently pull money out of the market. Consistent success requires mastery over the mind, a specific psychological state known as the zone. Most amateur traders enter a position while subconsciously refusing to accept the mathematical possibility of a loss. They click buy expecting a win, rather than acknowledging the inherent risk. This unaccepted risk triggers a freeze response when a trade turns red. The trader stubbornly holds a losing position, relying on blind hope to avoid the pain of being wrong. Professional traders view a stop loss as mandatory overhead, the literal cost of staying in the business. On the left, a shopkeeper pays rent to keep their doors open. On the right, the trader pays the stop loss to find out if their edge will play out. Mentally releasing the risk amount before clicking the button creates a sense of psychological liberation. The money is already spent. Accepting risk as a prepaid cost neutralizes the emotional impact of red candles, allowing for clinical, mechanical execution. Beginners often treat every single trade as a verdict on their intelligence. They see a single loss as a failure of their entire strategy. Trading operates like a coin flip. Get heads 3 times. The odds on the next flip remain 50-50. Past results don't influence the next event. Similarly, a 60% win rate statistically requires 4 losses out of 10 trades. Predicting the market's next micro move becomes unnecessary when a trader strictly follows the rules of a proven edge. Detaching from individual outcomes allows a trader to profit from the inevitable volume of statistical probability over the long term. A winning streak can be dangerous, inflating the ego until a trader abandons their rules in favor of reckless position sizing. Conversely, a string of losses often leads to revenge trading, where the trader aggressively fights the market to claw back their capital. Success demands radical emotional detachment. A trader must take personal responsibility for every outcome, without taking the market's random movements personally. In a state of neutrality, the emotional reaction to a winning trade is indistinguishable from the reaction to a losing one. The scale remains level. Breaking the emotional connection to money provides a shield against impulsive behaviors that destroy trading accounts. The most significant variable is the internal psychological state of the person executing it. Discipline can make an average strategy highly profitable, while fear frequently leads traders to abandon even the most statistically sound systems. Perform a self-audit. Is your greatest vulnerability the fear of missing out, or the paralyzing fear of a stop-loss hitting? Long-term profitability begins only after shifting the mindset from a gambler to a